Hello, ladies and gentlemen. Welcome back. This is Apatech TV again. In today's session, we are going to deal with the return in invested capital. What you call you have invested your capital in something, and also you are going to investigate, you are going to analyze what return from investment you did. So in this session we are going to explain into more detail, and also stay in touch, watch this video until it ends. In this topic, the topic we are going to discuss. The first one will be an importance of return on invested capital. The second will be the components of return on invested capital. The third will be analyzing return on assets. The fourth will be analyzing return on common equity. So I hope everyone is going to understand this very well, because if you know the importance of return on invested capital, you will also start to realize how to join the business. And also in topic 2, I will introduce to you the components of return on invested capital, and also you will realize that the components to get when you are invested is this. So in the third topic, we shall look about analyzing return on asset. When we say return on asset, you are making sales, and also there is amount of money you have invested in. So you are going to analyze where is the return, how many. So in the fourth, we shall analyze the common equity. Assume you have a company. That company providing shares to their shareholders, and also you are going to analyze the return from that shares you have sales you have provided to their shareholders. So let's go into detail. In preview, so let's show you how financial statement analysis it involves. So financial statement analysis involves assessing both risk and return. I hope you're understanding return and risk. Return comes from what you have invested. Risk is that you are meeting in your business. So return on invested capital refer to the company's earning relative to both the level and source of financing. I hope it is self-explanatory. Return on invested capital. This is refer to the company's earning relative to both level and source of financing. If you have a main source of financing, that means you are going to get earnings, the main earnings. So that earnings comes from the company's earnings. If that company have the large earnings, that means you are going to get the main return on invested capital. It is a measure of the company's success in using financing to generate the profit. It's measure the company's success in using financing to generate profit. That means if a company is showing a return on invested capital at a high level, that's showing that that company they have successful by using that financing to generate the profit. Financing might be a debt, maybe your own saving, or maybe your own asset. This chapter describes return on invested capital and its relevance to financial statements analysis. I hope I'm saying what we are going to look in this, because in this chapter we shall describe return on invested capital and the relevant to financial statement analysis. Here there is an importance of return on invested capital. We can analyze company performance in several ways, like revenue, gross profit, and net income. So I performed measure in common use, yet none of those measures individually are useful as a comprehensive measure of company performance. That means we have to use all, not use one. None of the individual are useful as comprehensive measure of the company. That means we have to analyze revenue, gross profit, and net income. I hope you're understanding this. Analysis of the company performance demand joint analysis, where we assess one measure relative to another. The relation between income and invested capital, referred to as return on invested capital or return on investment, is the most widely recognized measure of the company's performance. It allows us to compare companies on their success with invested capital. It also allows us to assess the company's return relative to its capital investment, risk, and return on alternative investment. I hope this is self-explanatory. We use return on invested capital in several areas of our analysis, that's including managerial effectiveness, level of profitability, earning forecast, planning, and control. That is where we use an invested capital. An invested capital are used in several ways. Return on invested capital to analyze our managerial effectiveness, level of profitability, earning forecasting, and planning and control. Yes, measuring managerial effectiveness, that means the level of return on invested capital depends on primarily on the skills, resourcefulness, and the motivation of management. If we were measuring return on invested capital, here for managerial effectiveness, it will be depends on primarily on the skills, resourcefulness, and motivation of management. How the management is motivating the workers, how we are using our resources, how the skills of management. So management is responsible for the company's business activity. Return on invested capital, especially when you are computing year basis, is a relevant measure of the company's managerial effectiveness. Let's go for measuring profitability. Return on invested capital is an important indicator of the company's long-term financial strength. This profitability measure has several advantages over other long-term measure of the financial strength or solvency that rely on the balance sheet items. It can eventually convey the return on invested capital from varying perspectives of different financing contributors. If you are measuring return on invested capital, it is an indicators for the company's long-term financial strength. That means we are measuring the profitabilities. The profitability means they have long-term measure of financial strength. Solvents. If you are saying solvents, that means the company, they have ability to pay our debtors. That means they have ability to pay the debtors, the creditors. So that means, so that is how the company using return on invested capital to show if their company, they have long-term financial strengths. When you are going for measuring of the forecasted earnings, this measure of effectively ranks past, current, and forecasted earning with the total invested capital. Here we are forecasting earnings in the future. That means we are going to look at the past and the current, and also we are forecasting our earnings to be happen in the coming year, in the coming months. So it depends. So expectations are returned from the historical and incremental rate of return, projected change in the company and business condition, and expected returns from the new project. I hope you are understanding this. Expectations are determined from historical, that means the past, incremental rate of return, the current, the projected change in a company, what's going to be changed in a company's condition, business's condition, and also what we are expecting to get in the new project we are going to do in the coming period. So when it comes for measure of the planning and the control, that means return on capital, it is the measure of this. Return on invested capital serves an important role in planning, like budgeting, coordinating, evaluating, and controlling business activities. As well-managed company exercise control over the returns achieved by each of its profit centers and rewards its manager on those results. This what I'm saying, this that means, as I have said before, we use return on invested capital in several areas of our analysis, where we look about the managerial effectiveness, where we look about the skills and the motivation management. When for level of profitability, we look about the strengths, financial strengths of our company, and also for earning or forecasting. That's I have said that here it is all about historical performance, and also we look for the current period, and also the return for expected in the coming period. For planning and the control, I said that this is about evaluation, coordinating, and also that's where the term invested capital is used in analysis in different areas. So my dear friends, continue to look at this. Let's go for the third topic. Here, this is the most common components of return on invested capital. Here, the first one is a differing view on income and invested capital. The second is those are different, are varied, and stems from the diverse perspectives of financial statement users. The third, this is a session describe those different and explain how different computations are relevant to different users of analysis. When you comes for defining invested capital, there is no universal measure of invested capital from which to compute rate of return. the different measure of invested capital used return reflect users' different perspective. As I have said in this, there is no universal measure of invested capital. There is no individual measurement from which to compute rate of return. The different measures of invested capital used, the different measures as used, you can calculate the total asset, you can calculate the revenue, you can calculate the gross profit. These are used differently to evaluate the invested capital return. The total assets. A company's return can be assessed from perspective of its total financial base liability plus equity, or simply total asset. This return on total assets is a relevant measure of operating efficiency. Total assets base for computing return on invested capital is subject to adjustment. So in total assets means the company return may be assessed from the perspectives of total financing, where you can basing on liabilities that the company takes, and also you can add the equity to get the total asset. As you know, in a financial statement, you have two sides. You may have total assets, and also you may have the total financing basis, where we take liability plus equity, or simply total asset. This is return on total asset. It's a relevant measure for operating efficiency. The total asset here, it is basing by computing return on invested capital, where we subject this at the adjustment, where they are an operating asset adjustment and intangible asset adjustment. In this adjustment here, when it comes for non-operating asset, the non-operating asset adjustment removes investment in a marketable security and exceed cash from the invested capital base. For intangible asset adjustment, this is another types of adjustment exclude the intangible asset from invested capital. Excluding those assets in total, however, is not justified as they represent valid investment by company management despite their intangible nature. For accumulated depreciation adjustment, it's the adjustment relative to whether invested capital based on including on add back for accumulated depreciation on depreciation assets. Analysts agree that these plants assets are maintained in primary working condition during their useful life. It is inappropriate to assess return relative to net asset. We must also recognize that maintenance and repairing costs commonly increasing as assets age, tending to offset the reduction in invested capital base. Let's go for equity capital. The use of equity capital as definition of invested capital gives us a measure of return on shareholders' equity. As I have said in a previous introduction, I've said that when you are buying an equity, when you are buying an shares, that means you are investing somewhere. So that means the invested capital gives us a measure of return on shareholders' equity. Book versus market value of invested capital. The market value are sometimes more relevant for analysis because certain assets are not recognized in financial statements. One adjustment is to use a market value of invested capital. Investor versus company invested capital. In computing return on invested capital, we must distinguish between companies invested capital and an investors invested capital. Our analysis of return on invested capital focuses on company and not on individual shareholders. Average invested capital for the period. The invested capital for the period is typically computed by using average capital available to a company during the period. An average is used to reflect the change in invested capital during the period. Let's look for definition of an income. The definition of an income or return depends on definition of invested capital. Yes, of course, if you are invested in different things, you are going to define income depends on what you have invested. If invested capital is defined as an asset, then income before interest expense is used. Similarly, excluded dividends, hence income before interest expense and dividends is used when you are computing return on assets. My dear friends, I'm going to show you the formula you have to use. In case of consolidated company, when I say consolidated company, that means the parent bought a subsidiary somewhere. So the invested capital is including asset of subsidiary. The income should include total income, not just parent shares. For this reason, we add back the minorities shares of the earning to income when you are computing return on asset. This is a formula how to computing return on invested capital. Return on total assets, that means the net income plus interest expenditure but excluding tax and dividends plus minority interest in income, and also you come with dividing the beginning total asset plus ending total asset, and also you divide by 2. That is a formula of calculating the net return on total asset. When it comes for return on common equity, that means we are going to take the net income minus preferred dividends, and also you divide average common equity. Let's go for analyzing a return on asset. A return on invested capital is useful in management evaluation, profitability analysis, earnings forecasting, and planning and control. This section examines a return when invested capital is viewed independent of its financial sources by using debt and equity capital, like total assets, commonly referred to as return on asset. Here, return on invested capital is useful in management evaluation. When management is evaluating, they use this, and also profitability analysis, earning forecasting, and planning. I'm saying for these 4 areas, as I have said in previously. This section examines return when invested capital is viewed independently of its financial sources using debt and equity capital, commonly referred to return on assets. Here there is a disaggregating return on assets. Sales is an important criterion to the judge company profitability, and is a major indicator of the company activity. This disaggregation of return on asset is a return on asset where equals to profit margin times asset turnover. How profit margin is equal? Profit margin is equal to income divided by sales. Asset turnover is equal to sales divided by assets. The income to sales relation is called profit margin and measure of the company's profitability relative to sales. The sales to asset relation is called asset turnover and measure of the company's effectiveness in generating sales from asset. This decomposition highlighting the role of those components, both profitability margin and asset turnover, in determining return on assets. There are relationship between profit margin and asset turnover. As you see in this an example, we have company X, company Y, company Z. A company X, they did a sales of 5 million and they get the income 500, and also they have asset of 5 million. So how to get the profit margin? As I have said that the profit margin will be equal to income divided by sales. That means we are taking 500 divided by 5 million times 100. That means the profit margin is 10%. As like this, 500 divided by 10m, and also you get 5%. So asset turnover will be equal to sales will be equal sales divided by assets. So as in this formula will be to sales divided by asset to get asset turnover, and means this is 5 million divided by 5 million to get this. So to get return on assets will be equal to profit margin times the asset turnover, where we are going to take 10% times 1%, and also you get return on asset. It is a practical, and this the second an example. So both companies return on assets are poor, yet the strategically corrective action for each difference. Company A has a 10% of profit margin, while company B is considerably lower. As we see in this an example, it is a lower 0.5. On other hand, a dollar invested in asset yield only 0.10 in sales for company A, whereas company B achieves $2 in sales for invested. According to our analysis forecast on our company A's asset, asking questions such as why turnover is low? Are their assets yield little or return? That's the question we have to ask ourselves. Are their idle assets require disposal? Are assets ineffectively or ineffectively utilized? We can expect that company A can achieve immediately improvements by concentrating on increasing turnover, by increasing sales, reducing investment, or both. Company B comfortably a much different scenario. Company B should focus on correcting its lower profit margin. Reason for low profit margin includes inefficient equipment or production method and product profitability, product line, excess capacity with a high fixed cost or exclusive sales and administrative expense. Asset turnover analysis. Asset turnover analysis measure the intensive ways where the company utilizes asset. The most relevant measure of asset utilization is sales, since sales are essential to profit. This session describes various analysis by using disaggregation of asset turnover. This is aggregation of asset turnover. The standard measure of asset turnover is termed return on asset, where we take sales divided by asset. Further evaluation of change in turnover rates for individual assets can be useful in a company analysis. Let's go for sales to cash. All business have and must maintain relation between sales and cash. A too high cash turnover and a low cash turnover, both situations are not ideal for the smooth and profitable business operation. I hope you understand this, my dear friend. Sales to receivable, that means the level of receivable is a function of sales. A low receivable turnover is like due to overextending credit. A high receivable turnover can imply strict credit policy. Receivable turnover often involve a trade-off between increased sales and accumulation of funds in receivables. When it comes for sales to inventory, maintaining sales typically require inventory. A low inventory turnover often suggests overstocked, slow movement, or obsolete inventory. It can also be a signal of estimating of sales. A high turnover can imply under investment in inventory, strengthening customer relationship and the future sales. Inventory turnover involves a trade-off between funds accumulated in inventory and the potential loss of customer and future sales. Sales to fix the assets. Duration between sales and fixed assets is long-term and fundamental to most companies. Our analysis must remember increasing in fixed assets are typically not gradual but occur in large increments. This process can create change in fixed asset turnover, with facilities often not appearing on balance sheet can solve this turnover. The fixed asset turnover involves a trade-off between investment having high gestation period versus more efficient, productive investment with high sales potential. Okay, thank you very much. My God bless you for turning back, for watching our video for this Apatech TV. My dear friends, remember to subscribe for Apatech TV. God bless you. Like, share to others, and then we shall meet for the next session. God bless you, my dear friend, and God bless Rwanda. Thank you very much.